All right, buckle up. Welcome to the deep dive.
Great to be here.
Today, we're cutting straight to the chase and plunging into something really foundational, the ethical bedrock of a truly vital profession, the AICPA Code of Professional Conduct.
Yeah, it's more than just a rule book.
Definitely. It's like the ethical DNA for certified public accountants, and, it touches every single thing they do.
And what's really fascinating, I think, is how this set of principles, which they voluntarily embrace, becomes the foundation of trust for the whole field. It's the CPA's promise, really, to stick to what is right and just that's absolutely critical for serving the public interest.
And that's our mission today for you listening. You've brought us the sources, the code itself, and we're here to navigate it, pull out the most important stuff.
Get right to the core insights.
Exactly. Give you that shortcut to understanding what it really means to be a CPA with integrity. We'll cover the structure, the core ideas, and those specific rules that keep things ethical.
Sounds like a plan.
So let's start with the basics. What exactly is the AICPA Code of Professional Conduct?
Okay, well, think of it as the main ethical guide. It governs pretty much any service an AICPA member performs.
Like what kind of services?
Oh, everything. From auditing a huge company's financials, giving tax advice to an individual, even crafting financial projections for, say, a new startup.
So its reach is really broad then?
Incredibly broad, yeah. It covers members in public accounting firms, obviously, but also those working inside companies, maybe in corporate finance.
Like a CFO or controller?
Exactly. And even CPAs who are retired but still keep their license active. It applies.
Wow.
And, the fact that a code like this even exists is a big deal. It's kind of a hallmark of a true profession.
How so?
It shows that CPAs accept this significant responsibility towards the public. They freely agree to these high standards, ultimately to benefit society. Is their public promise to act with integrity, objectivity, upholding that public trust above all else.
That makes sense. And to help folks navigate this ethical landscape, you mentioned it's structured logically.
Very logically, yes. Think of it like building a house. You start with the big overarching principles. Those are your foundational pillars.
Okay.
Then come the more specific rules. They're like the detailed building codes, telling you what you can and can't do.
Got it. Rules.
After that, you have interpretations of those rules. These are like the blueprints, showing exactly how to apply a rule in a specific situation.
Ah, okay. The practical application.
Right. And finally, there's other guidance for those unique situations that might not fit neatly into the other categories. It's a really comprehensive, layered framework.
That structure helps.
And to make sure everyone's on the same page, the code even defines specific action words. Very precisely.
Oh, like what?
Well, for instance, if the code says a member needs to consider something, it means they have to really think about several different matters, not just glance at it.
Okay, deliberate thought.
Right. If it says evaluate, they need to assess something, weigh its significance. It implies judgment. And if it says determine, that means the member has to come to a definite conclusion, make a clear decision. These precise terms are really key to applying the code consistently.
That level of detail is impressive. So, given how broad and detailed it is, does it apply the same way to all CPAs? You mentioned different roles.
That's a great question. And no, it doesn't apply identically. It smartly tailors its guidance.
How does it do that?
It segments the advice into three main parts. There's one part specifically for members in public practice, your typical audit or tax firm, CPAs.
Right.
Then there's a separate part for members in business and controllers, CFOs, internal auditors working inside a company.
Okay, the industry folks.
Exactly.
Yeah.
And then there's a third section for other members. This covers pretty much anyone else holding a CPA license. Maybe they're educators, retired, or between jobs.
So it makes the rules relevant for where you actually work.
Precisely. It makes the guidance practical for each unique professional setting.
That makes perfect sense. Okay, moving past the structure then. Let's talk about those foundational pillars you mentioned, the 6 principles. You called them the guiding stars.
Yeah, I think that's a good way to put it. They aren't just suggestions. They are the absolute bedrock, the core values every single CPA is expected to live by.
They set the tone, basically.
They really do. They establish the fundamental ethical mindset, the compass for every CPA. They dictate how a CPA should approach their work and responsibilities.
All right, let's unpack them. First one, responsibilities.
Okay.
The code says, in carrying out their responsibilities as professionals, members should exercise sensitive professional and moral judgments in all their activities. What does that actually mean in practice?
It means you, as the professional, need to constantly step back. Think about the ethical side of things, the broader impact of your decisions, not just, whether the numbers add up technically.
So it's about being thoughtfully ethical.
Thoughtfully ethical in everything you do. That's a good way to phrase it.
Okay, second principle.
Building right on that is the public interest. Members are called to serve the public interest, honor the public trust, and demonstrate commitment to professionalism.
That sounds pretty direct.
It is. It explicitly links the accounting profession to its vital role in society. It reminds CPAs that their work serves something bigger than just the client or their employer.
They're like stewards of financial integrity.
Exactly. Stewards for society at large. That's the idea.
Got it. Next up, integrity.
This one's powerful. It says, members must perform all professional responsibilities with the highest sense of integrity.
Back to that right and just idea.
Precisely. It emphasizes unwavering honesty, strong moral character in everything you do professionally. No cutting corners, no bending the truth, just straight-up integrity.
Clear enough. Number 4.
This is objectivity and independence, and this is where things get really critical and sometimes a bit complex.
Okay, lay it out for us.
It mandates that a member should maintain objectivity and be free of conflicts of interest in discharging professional responsibilities. That's the first part.
Objectivity. Got it.
But then it adds a crucial specification. A member in public practice should be independent in fact and appearance when providing auditing and other attestation services.
So there's a distinction there. That's important for you listening to really grasp, right? Because it can be confusing.
It really can. Objectivity is the broad requirement. It applies to all services a CPA performs. You have to be impartial, unbiased, whether you're doing an audit, tax prep, consulting, whatever.
Okay, objective all the time.
But independence,
Yeah.
that's much more specific. It applies only to attest services.
And attest services are?
Think audits, obviously, but also special reports, examinations of, say, prospective financial information, agreed upon procedures, engagements, and reviews of financial statements.
Okay, the services where you're giving an opinion on reliability.
Exactly. For those services, CPAs aren't just advisors. They're providing assurance, an opinion on the reliability of that financial info. And that's why they must not only be independent in their mind, that's independence in fact, but also appear independent to any reasonable outside observer. That's independence in appearance.
It's all about ensuring complete public trust in their unbiased opinion.
Couldn't have said it better myself. That's the crux of it.
Okay, 5th principle.
Due care. This principle says a member should observe the profession's technical and ethical standards, strive continually to improve competence and the quality of services, and discharge professional responsibility to the best of the member's ability.
So basically, stay sharp, keep learning, and do good work.
That's it in a nutshell. Maintain your skills, stay current with all the standards and rules, and be diligent. It's a commitment to lifelong learning and just, well, professional excellence.
Makes sense. And the last principle.
The 6th is scope and nature of services. This one guides members in public practice specifically. It's about deciding what services they offer and how they offer them, making sure it all aligns with the code.
So what does that actually involve?
It really boils down to 3 key things for firms. First, they need adequate internal quality control systems. Make sure their work is consistently high quality across the board.
Okay, quality control.
Second, they have to constantly assess potential conflicts of interest, especially if they're providing non-audit services to their audit clients.
Right, that objectivity independence thing again?
Exactly. And third, they need to evaluate whether all their firm's activities, everything they do, are consistent with the profession's overall commitment to professionalism. It's about making sure the services offered don't undermine the core ethics.
So ensuring the business side doesn't compromise the professional standards.
Precisely.
Okay, so those principles are like the ethical North Star guiding the way. But how do they translate into, day-to-day actions?
That's where the rules come in.
Right, the building codes, you call them.
Exactly. This section provides much more detailed, specific, actionable guidance for members dealing with particular situations.
And these rules apply differently depending on your role.
Yes, the code is very clear about that. For example, the independence rule, which we're about to dive into, is primarily for members in public practice doing attest work.
Okay.
But other rules, like, say, the Act's discreditable rule, apply universally to literally every single AICPA member. Doesn't matter if they're in public practice, industry, or retired.
Got it. So let's dive deep into some key rules, starting with that big one, the independence rule, 3.1.
Absolutely paramount. especially for attest services. And yeah, if you're studying for the CPA exam, you really need to know this section inside and out.
And the crucial reminder here is independence is a must for attest services, but not required for things like compilations or general tax and consulting work, right?
Correct. For those non-attest services, objectivity is still required, but not the higher bar of independence.
So to really get independence, you said we need to know who a covered member is. Why is that so important?
Because the covered members,
Yeah.
plus their immediate family, so spouse and dependents are the ones generally subject to this independence rule. It defines who needs to be independent.
Okay, so who is a covered member?
It's basically anyone who's directly involved in or can influence the attest engagement. So that includes, obviously, anyone on the actual attest engagement team.
Makes sense.
Anyone in a position to influence that engagement, like a supervisor or manager reviewing the work.
Okay.
A partner in the firm who provides more than 10 hours of non-attest services to that same client within the fiscal year.
Interesting detail, the 10 hours.
Yeah, it's quite specific. Also, any partner who works in the same office as the lead attest engagement partner.
Even if they don't work on that client.
Even if they don't work on that specific client, yes.
Yeah.
The firm itself is a covered member. And any entity whose operating policies can be controlled by any of these individuals or by the firm.
Wow, that's a broad net. Defines those concentric circles, like you said.
It does. It ensures everyone significantly connected to the engagement or the client relationship is captured.
So how can this crucial independence be compromised or impaired? Let's start with financial interests. 3.1.1.
Okay. The big one here is direct financial interests. Independence is impaired if a covered member has any direct financial interest in an attest client, period.
Any, regardless of size.
Regardless of materiality. Doesn't matter how small. It's what we call a bright line rule. So owning even one share of stock in the client that's direct, independence impaired. Even if it's held in a blind trust.
Even a blind trust. Wow.
Yep. Or being a general partner in a client partnership. Direct interest impairs independence.
Yeah.
Being a trustee of a client trust, same deal.
Okay, direct is clear. Basically,
Okay.
any direct ownership stake, however small. What about indirect?
Right. Independence also gets impaired by material indirect financial interest.
So indirect means there's a step removed.
Exactly. There's some intermediary. Like say you own shares in a mutual fund. You don't directly own the stocks the fund holds.
Mm-hmm.
But if that mutual fund invests in your attest client, you have an indirect financial interest. Or maybe you own stock in Company A, and Company A owns a big chunk of your attest client. Indirect interest again.
And for indirect, it has to be material to impair independence.
Yes, material to the covered member's net worth. If that indirect interest is material to you, then independence is impaired. The underlying idea is that any financial connection, direct or indirect, needs close scrutiny.
Got it. What else under financial interests? Loans, gifts.
Yep. Loans to or from an attest client generally impair independence for covered members and their immediate family.
Okay.
And gifts. This one trips people up sometimes. Accepting anything more than just a token gift from an attest client can also impair independence. It's about avoiding even the perception of being influenced.
Right, perception is key. Are there exceptions for loans, like mortgages?
There are some very specific exceptions, but mainly related to financial institution clients. Independence is generally not impaired by things like fully collateralized car loans obtained under normal terms, credit card balances that don't exceed $10,000 by the payment due date, fully insured bank accounts up to the FDIC limit, for instance, or a loan secured by your cash surrender value, like a passbook loan.
Okay, specific practical exceptions.
Very specific. And another important point here involves close relatives. Think parents, siblings, non-dependent children.
Mm-hmm.
If a covered member knows that a close relative has a financial interest in the attest client that is material to that relative, or if that relative has significant influence over the client, like being a key executive, that can also impair the CPA's independence.
So family ties matter, too.
They definitely can create perceived or actual conflict.
Okay, that covers financial interests pretty well. What about employment relationships? 3.1.2, how do they impact independence?
Employment ties can definitely get tricky. For example, independence is impaired if someone who used to work for the client joins the attest engagement team, and their work on the engagement covers the time period when they were actually employed by that client.
Makes sense. You can't audit your own past work effectively.
Right. It's also impaired if an immediate family member's spouse dependent, or even close relative works in a key position with the attest client.
What counts as a key position?
Think of roles with influence over the financial statements or accounting records, like the client's controller, CFO, chief accounting officer, internal auditor, treasurer, those sorts of roles. Imagine your spouse being the client's controller.
Yeah, definitely blurred lines there.
Absolutely. And what if someone leaves the CPA firm to go work for the client?
Good question.
If a partner or professional employee leaves the firm and immediately takes a key position with an attest client, independence can be impaired.
Can be, or is.
It is impaired unless certain conditions are met, like the person can no longer influence the firm's operations or financial policies, and any money the firm still owes them, like retirement benefits, is immaterial to the firm.
Okay, so there are safeguards.
Yes. And there's also a specific one-year cooling-off period rule for public company audits. If a member of the audit team takes a key financial reporting oversight role at the client within 1 year of leaving the engagement, independence is generally impaired.
A cooling off period, okay.
And crucially, if anyone on the engagement team is even seeking or discussing potential employment with an attest client, they have a duty to notify their firm immediately and be removed from that engagement.
Wow, even just discussing it.
Yes. The appearance of a potential conflict is enough to require action. It's a strict standard.
That's a powerful reminder about appearance. Okay, then there are business relationships, 3.1.3. What impairs independence here?
The big one is making management decisions for an attest client. That's a definite no-no. CPAs performing attest services cannot act as a director, officer, or employee of that client, or serve in any kind of management capacity.
So you can't wear both hats?
Absolutely not.
Yeah.
It extends to performing functions that are considered management responsibilities.
Yeah.
Like you can't authorize client transactions, have custody of their assets, supervise their employees in their normal duties, or even design their financial information systems if you're also the auditor.
That seems like a very clear boundary. What about providing other non-attest services? Can that impair independence?
Yes, some specific non-attest services can impair independence if performed for an attest client. Things like certain appraisal or evaluation services, especially if they're material, involve a lot of subjectivity.
Okay.
Managing the client's internal audit function impairs independence. Acting as a decision maker in litigation services, like being a mediator or arbitrator for the client, would also impair it.
Are there exceptions for business relationships?
There are a few narrow ones. For example, being an honorary trustee for a not-for-profit organization generally doesn't impair independence, as long as the position is purely honorary and you don't participate in management.
Okay.
And just being a member of the same trade association as a client usually doesn't impair independence either, unless, again, you end up serving in a management role within that association.
Gotcha. And finally, under independence, what are the other reasons for impairment? 3.1.4.
A couple of key ones here. First, overdue professional fees. If an attest client is more than 1 year late in paying their fees to the firm, independence is considered impaired.
So you can't audit someone who owes you significant old fees?
Generally, no. The previous year's fees usually need to be paid before the firm can issue a report for the current year. It avoids a self-interest threat.
Makes sense. What else?
Litigation. Any actual litigation, or even just the express threat of litigation between the auditor and the attest client, can impair independence.
Whether the auditor is suing or being sued?
Either way, if the auditor is suing the client management alleging fraud, or if the client is suing the auditor alleging deficiencies in the audit work, independence is typically impaired. The relationship is just too adversarial at that point.
Is there an exception?
The only real exception is if the lawsuit is clearly immaterial and completely unrelated to the attest service itself. But generally, litigation signals a breakdown in the relationship that compromises independence.
Okay, so the bottom line for independence, if you're doing an attest service, you need to be squeaky clean, both in reality and in how things look, free from any ties that could even suggest your judgment might be swayed.
That's it, exactly. It's a huge responsibility, foundational to the value of the audit.
Truly is. Okay, moving beyond independence specifically, let's talk about the integrity and objectivity rule, 3.2. This applies more broadly, right?
Yes, much broader. This rule says that in the performance of any professional service, a member shall maintain objectivity and integrity, shall be free of conflicts of interest, and shall not knowingly misrepresent facts or subordinate his or her judgment to others.
So this covers tax, consulting, everything.
Everything. Now, it does mention conflicts of interest. Sometimes, a potential conflict might be permissible if it's fully disclosed to the client and any other relevant parties, and they consent to the member proceeding.
Ah, so disclosure and consent can sometimes work.
Sometimes, for general conflicts. But, and this is critical disclosure, and consent cannot overcome an independence impairment if independence is required for the service, like an audit.
Yeah.
You simply cannot consent your way out of independence requirement.
Got it. Independence rules trump consent.
Absolutely.
Next, the General Standards Rule, 3.3. This sounds like basic good practice.
It is. It lays out 4 core standards that apply to all engagements, setting a baseline for quality work.
What are the 4?
First, professional competence. Basically, don't take on work you're not qualified to do. You or your firm need the technical skills, knowledge, and ability to supervise appropriately.
Okay,
Second, do professional care. This means exercising the skill and diligence that other reasonably prudent accountants would in similar circumstances. Critically review your work and the work of those you supervise.
diligence. Got it.
Third, planning and supervision. Pretty straightforward. Adequately plan any engagement and properly supervise anyone working on it.
Makes sense.
And fourth, sufficient relevant data. You need to gather enough appropriate evidence or data to have a reasonable basis for any conclusions, recommendations, or reports you issue. Don't base opinions on flimsy evidence.
So competence, care, planning, and evidence, the fundamentals of quality.
Exactly.
Then there's the Compliance with Standards Rule, 3.4. What standards are we talking about here?
This rule says a member performing auditing, review, compilation, consulting, tax, or other professional services must comply with the standards set forth by bodies designated by the AICPA Council.
So who are these bodies?
It's a list that includes the Auditing Standards Board, ASB, for non-public company audits, the PCAOB, that's the Public Company Accounting Oversight Board for public company audits.
Right, post-Sarbanes-Oxley.
Exactly. Also, the FASB, Financial Accounting Standards Board, which sets U.S. GAAP, the IASB, International Accounting Standards Board, for IFRS, the GASB for governmental accounting, and others depending on the specific service. It basically ensures CPAs follow the established professional rulebook for whatever they're doing.
Keeps everyone playing by the same technical rules.
Precisely.
Next, the Accounting Principles Rule, 3.5.
This sounds related.
It is. This rule specifically deals with financial statements. It says a member cannot state that financial statements are presented in conformity with generally accepted accounting principles, base app, or state they aren't aware of any material modifications needed for conformity with GAAP if those statements actually contain any material departures from GAAP.
So you can't sign off on financials that materially violate GAAP.
Correct, unless there's a very rare exception.
What kind of exception?
The rule allows for departures if, due to truly unusual circumstances, sticking strictly to GAAP would actually make the financial statements misleading. That sounds like a high bar. What qualifies as unusual?
The interpretations give examples like brand new legislation or completely new forms of business transactions where existing GAAP might not fit well yet. What definitely doesn't qualify is just, an unusual degree of materiality or the fact that some companies in the industry do things differently.
So it has to be a fundamental issue with applying GAAP itself.
Yes. And even then, if a departure is justified under this rare exception, the departure, the reasons for it, and its effects must be fully described and disclosed right there in the financial statements or the report. Transparency is paramount.
Okay, makes sense. Now, confidentiality. The Confidential Client Information Rule, 3.6.
This one's pretty straightforward on its face. A member in public practice cannot disclose any confidential client information without getting the client's specific consent first. Protect your client's sensitive data.
Seems obvious, but are there times when you have to disclose without consent? That often raises questions.
Yes, and that's a crucial point. While client consent is the general rule, there are key exceptions where disclosure is actually required or permitted, even without consent.
Like what?
The big one is complying with a validly issued subpoena or summons from a court or government agency. If you get a legal order, you generally have to comply.
And do you have to tell the client you got the subpoena?
Generally, no. The CPA isn't typically required by the ethics rules to notify the client, though legal advice might be sought. Another exception is for peer reviews, quality reviews of the firm's practice conducted under AICPA or state society programs.
Okay, for quality control.
Right. And also responding to an inquiry from the AICPA's Professional Ethics Division or a state CPA society's disciplinary body. If they investigate a complaint, you have to cooperate and provide information, even if it's confidential client info.
So confidentiality is vital, but it has legal and professional oversight limits.
Exactly. It's not absolute.
Okay, let's talk fees. The contingent fees rule 3.7. What's a contingent fee and when is it banned?
A contingent fee is basically a fee that depends on achieving a specific result or outcome. You only get paid, or get paid a certain amount, if something particular happens.
Like a percentage of tax savings.
That could be one type, yes. The rule strictly prohibits contingent fees for any service performed for a client for whom the member or their firm also performs an attest service, like an audit or review.
Why is that?
It creates a massive self-interest threat. If your audit fee depended on the client getting a clean opinion or achieving certain financial results, your objectivity and independence would be shot. Public trust gone.
Makes perfect sense. Where else are they banned?
Also banned for preparing an original or amended tax return or a claim for a tax refund for any client. You can't charge based on the size of the refund, for example.
Okay, so when are contingent fees allowed?
They are permitted in a few specific situations. For example, if the fee is fixed by a court or another public authority, or in tax matters, if the fee is based on the results of a judicial proceeding or the findings of a governmental agency, like representing a client during an IRS examination. The outcome is determined by a third party, not the CPA.
Ah, okay. The determination is independent.
Right. And also, interestingly, contingent fees are allowed for compiling financial statements for a client, but only if the member includes a statement in their report indicating they are not independent.
So allowed for compilations, but with a clear disclosure of non-independence.
Exactly. Transparency again.
All right, next rule. Acts discreditable, 3.8. This sounds like a catch-all.
It kind of is. It says a member shall not commit any act that is discreditable to the profession. It's broad, covering a whole spectrum of behaviors that could harm the reputation of CPAs.
What are some specific examples listed?
Oh, quite a few. Things like refusing to return client-provided records after the client demands them back, even if fees are unpaid, although work product might be retained.
Okay, client records.
Any finding by a court or agency of illegal discrimination or harassment in employment practices. Negligence in preparing financial statements or records.
Negligence counts as discreditable.
Yes. Also, failing to follow required government auditing standards on a government audit unless you disclose the failure and the reasons. Soliciting or knowingly disclosing CPA examination questions or answers, obviously a huge breach of integrity.
Definitely.
Failing to timely file your own personal or firm tax returns, or failing to remit payroll taxes collected for employees, that looks really bad for a CPA.
Yeah, practice what you preach.
Right. Also, making false or misleading entries in records, or failing to correct materially false entries when you have the authority. Taking or keeping client files or proprietary firm info without permission when you leave a firm. Disclosing confidential info obtained from a prospective client without consent. It's really about upholding the profession's integrity in all aspects.
It covers a lot of ground, basically conduct unbecoming a professional.
That's a good summary.
Okay, related to reputation, what about the advertising and other forms of solicitation rule, 3.9?
This rule says a member in public practice can't seek clients using advertising or other solicitation that's false, misleading, or deceptive. Pretty straightforward.
What makes advertising misleading?
Things like creating false or unjustified expectations of favorable results, implying you have the ability to influence any court, tribunal, or regulatory agency, making statements you can't substantiate, intentionally underestimating fees to lure clients. Basically anything that a reasonable person would likely misunderstand or be deceived by.
Just be honest and transparent in your marketing.
That's the core principle.
All right, commissions and referral fees rule 3.10. This ties back to objectivity too, right?
Absolutely. This rule says a member in public practice generally cannot accept a commission for recommending any product or service to a client for whom they also perform attest services, audit review, etc.
Same reason as contingent fees self-interest threat.
Exactly. You can't get paid by a third party for recommending something to your audit client. It compromises your objectivity. The ban also applies if you compile financial statements for a client, but don't disclose your lack of independence.
Okay. Are commissions ever allowed?
Yes. If you're providing services where independence isn't required, like tax or some consulting, you can receive a commission for recommending products or services, but, and this is key, only if you disclose the commission arrangement to the client beforehand.
Disclosure is mandatory.
Mandatory. And the same goes for referral fees. Fees paid or received just for referring a client to another CPA or vice versa. Any referral fee arrangement must always be disclosed to the client.
Transparency, transparency, transparency.
It's the theme for commissions and referrals.
Last rule in this section, form of organization and name rule, 3.11. What's this about?
This focuses on how CPA firms are structured and named, ensuring it's not misleading to the public. For instance, a firm can't use a name that implies it's a partnership or corporation if it's not. And you can't use designations like members of the AICPA unless all the CPA owners are actually AICPA members. Similarly, you can't call your firm Certified Public Accountants or CPAs unless all owners holding equity are CPAs.
What if not all owners are CPAs? Can non-CPAs own part of a firm?
Yes, non-CPAs can own a minority interest in a CPA firm, but there are strict rules. The majority of the financial interests and voting rights, over 50%, must belong to licensed CPAs.
Majority owned by CPAs.
Right. And any non-CPA owner must be actively engaged in providing services to the firm's clients as their principal occupation. And critically, a licensed CPA must always have ultimate responsibility for all the services provided by the firm, attest, tax, everything.
So CPA supervision is key.
Absolutely. And those non-CPA owners, while they can have titles like principal or director, they cannot hold themselves out to the public as being CPAs.
Makes sense. What about firm names? Can you keep old partner names?
Yes. Firms are generally allowed to continue using the names of past owners, and if a partnership dissolves, a sole practitioner who continues the practice can use the old partnership name for up to 2 years.
Okay, practical rules there. What about CPAs working in private industry? How should they use the CPA title?
If you're a CPA working as a controller or CFO in a company, you can use the CPA designation after your name on reports or documents you sign. However, it's crucial that this use does not imply that you are independent of the company you work for, because you're an employee.
Right, you lack independence from your employer.
Exactly. So the guidance advises that it's often best practice to also include your actual employment title, like controller or VP finance, along with the CPA designation to avoid any potential misunderstanding by readers.
Clarity about your role is important.
Very.
Okay, wow. We've covered the principles, the detailed rules. But what happens in those gray areas when a situation comes up that isn't explicitly covered by a specific rule?
Now we get to the really interesting part, and frankly, a very clever part of the code. The conceptual frameworks.
The safety net, you called it earlier.
That's right. The conceptual frameworks are designed for exactly those situations. They apply when the existing rules or interpretations don't quite give enough guidance, or maybe more commonly, when a member identifies a potential threat to their compliance with the rules or principles.
A threat, like the ones we touched on with independence.
Exactly, those kinds of threats, yes. But it's vital to understand, you cannot use a conceptual framework to somehow justify ignoring or overriding a specific rule that does exist in the code.
So it's for the gaps, not for loopholes.
Precisely. It's the ethical toolkit for navigating the gray areas, the unforeseen circumstances, the situations where threats might compromise your objectivity or integrity, even if no specific rule is broken.
How many frameworks are there?
The AICPA code has 3 distinct conceptual frameworks. There's one specifically for members in public practice dealing with integrity and objectivity threats. There's another one dedicated solely to independence.
Which makes sense, given how critical independence is.
Absolutely. And then there's a third framework for members in business, addressing the threats they face within their employing organizations.
And what if you wear multiple hats? Like maybe you work in industry but do some public practice on the side.
Good question.
Wow.
In that case, you need to consult all the applicable parts of the code and frameworks relevant to your different roles. And importantly, you must always apply the most restrictive provisions that apply to your circumstances.
Always take the stricter path.
When in doubt, yes.
So how does this framework approach actually work? You mentioned steps.
It's a clear, logical, 3-step process, very practical. Step 1, identify threats to compliance with the fundamental principles or rules.
Okay, spot the danger.
Step 2, evaluate the significance of those identified threats. Are they trivial, or are they serious enough to potentially compromise your compliance?
Assess the risk level.
Right. And step 3, if the threat is significant, you need to apply safeguards to either eliminate the threat completely or, if elimination isn't possible, reduce it to an acceptable level.
Okay, identify, evaluate, safeguard. But what's an acceptable level? That sounds a bit subjective.
It's defined quite carefully. An acceptable level is the point where a reasonable and informed third party, knowing all the relevant facts and circumstances, would likely conclude that the member's compliance with the rules is not compromised.
So it's an objective third-party test. Would a knowledgeable outsider think you're still okay?
Exactly. It's about maintaining that public confidence. If safeguards can't reduce a threat to that acceptable level, then you might have to decline or discontinue the specific service, or even resign from the client or your employment position.
Wow, so the consequences can be significant.
They can be. Ethics comes first.
Let's break down those threat categories again. Recognizing them seems crucial. You mentioned adverse interest threat.
Yes. That's when the member's interests are opposed to the interests of the client or their employing organization. The classic example is litigation between the member or firm and the client. Your interests are now directly adverse.
Okay. Then advocacy threat.
This is the risk that you promote your client's interest or position so much that you lose your objectivity or, if applicable, independence. Like vigorously endorsing a client's products or services, or acting as an advocate for them in resolving disputes with third parties, or promoting and attest client stock in an IPO.
You become their cheerleader instead of an objective professional.
That's the danger, yes. Then there's the familiarity threat.
Get too close.
Exactly. Becoming too sympathetic to a client's interests or too accepting of their work or explanations because of a long or close relationship. Maybe a member on the attest team has a close friend who holds a key position at the client company. Or maybe a member in business regularly accepts significant gifts or excessive entertainment from a key vendor. That closeness can subtly erode professional skepticism over time.
Okay. What about management participation threat?
This one applies mainly in the public practice and independence frameworks. It's the risk that the member essentially takes on a management role or performs management functions for the client. We talked about this under independence, serving as an officer or director, making key operational decisions, supervising client employees in their regular duties.
Things that blur the line between auditor consultant and actual management.
Oh, precisely. That's prohibited for attest clients.
Next, self-interest threat. This seems pretty fundamental.
It is. It's the risk that you could benefit, financially or otherwise, from an interest in or relationship with a client or your employer, which could adversely affect your judgment.
Examples?
Having a direct financial interest in a client, obviously. A firm relying excessively on the fees from one major client that creates pressure. Or for a member in business, maybe your potential bonus is tied directly to the financial results you're involved in reporting. That's a clear self-interest threat.
Your personal gain could cloud your professional judgment.
That's the risk. Then there's the self-review threat.
Reviewing your own work.
Essentially, yes. It's the risk that you won't properly evaluate the results of a previous judgment you made, or a service performed by you or someone else in your firm or organization when you're forming a judgment as part of a current service.
Like auditing the bookkeeping you just did.
That's the classic example for public practice. Or for a member in business, maybe you prepared some data when you were in one role and now in a new role, you're supposed to review that same data critically. It's hard to be objective about your own prior work.
I can see that. And the last one, undue influence threat.
This is about pressure. It's the risk that you'll subordinate your professional judgment to an individual associated with the client or your employer because of their reputation, expertise, aggressive personality, or attempts to coerce or excessively influence you.
So being pushed around.
Basically, like a client threatening to fire the firm or withhold future work if the firm disagrees with them on an accounting treatment, or pressure from a supervisor within your own company to book questionable revenue entries to meet targets. That's undue influence.
Okay, so those are the 7 major threats. Once you identify one and decide it's significant, you apply safeguards. What do those look like?
Safeguards are actions or other measures designed to eliminate the threat or reduce it to that acceptable level. They fall into a few broad categories.
Sure.
First, there are safeguards created by the profession, legislation, or regulation. These are things built into the system, like continuing education requirements on ethics and independence, the professional standards themselves, external quality reviews, peer review, legislation like Sarbanes-Oxley, even resources like ethics hotlines provided by professional bodies.
The infrastructure of the profession.
Right. Second, there are safeguards implemented by the client for public practice or the employing organization for members in business.
What kind of things can the client or employer do?
Things like having their own personnel with the right skills and knowledge to make managerial decisions and oversee the CPA's work. having a strong tone at the top that emphasizes ethical conduct and fair financial reporting. For public companies, having an active, knowledgeable, and independent audit committee is a huge safeguard.
Can you rely just on what the client does?
No, that's a critical point. A member cannot rely solely on safeguards implemented by the client or employer to reduce a significant threat. The member or their firm must also implement their own safeguards.
Okay, so what safeguards can the firm implement for public practice?
Firms can implement a wide range. Documented policies on identifying threats, ethics, and independence. Mandatory consultations on complex matters. Strong client acceptance and continuance policies, maybe dropping clients that pose too high a risk.
Yeah.
Policies to monitor reliance on fees from a single client. Rotating senior personnel off engagements after a certain period. Having robust internal quality control and review processes. Removing an individual from an engagement team if they have a specific threat, like a familiarity threat.
Lots of internal controls for the firm itself.
Exactly. And similarly, for members in business, there are safeguards the employing organization can implement discernibly. Again, that strong ethical tone from leadership is crucial. Having an effective audit committee or equivalent oversight body, clear internal policies requiring disclosure of interests or relationships that might pose conflicts, strong HR policies focused on hiring competent staff and preventing undue pressure on employees, whistleblower policies. These internal controls within the company can act as safeguards for the member in business.
It sounds like a multi-layered defense system against ethical lapses.
That's a very good way to think about it. The rules provide the clear boundaries, and the conceptual framework provides the process and tools for navigating the complex territory in between, always aiming for that acceptable level of ethical compliance.
So, bringing it all together, what does this really mean for you, the listener? We've unpacked this incredibly robust, honestly quite complex ethical framework that guides CPAs.
Yeah, it ensures they act with integrity, maintain objectivity, stay independent when needed, and always consider the public interest. It's not just a document. It's a living framework, the moral compass.
It really underpins everything.
It does. If you connect this to the bigger picture, it's clear this code isn't just some static list of do's and don'ts. It's this dynamic agreement, constantly interpreted and adapted, all to uphold public trust in financial information and professional advice.
That trust makes our financial markets work, right?
Absolutely. It underpins the confidence we all place in audited financial statements, in tax advice, in business consulting provided by CPAs. It's the silent guardian, maybe, of financial credibility.
So, a final thought for everyone listening. Next time you see a financial report signed by a CPA, or get professional advice from one, maybe pause for a second. Consider these invisible but incredibly strong ethical threads that bind their work. How does knowing about this deep ethical framework change how you perceive the huge responsibility these professionals carry? And maybe what does that imply about the trust you place in expert advice, not just from CPAs, but across any field?
That's a great question to ponder. It really highlights the value of professional ethics.
It certainly does.